Oil, Russia's chief export earner, and as oil prices go, so goes the Russian stock market. The 30 stock MySix is down 2% this week, reflecting recent declines in oil. For the year, though, the MySix has climbed 75% as crude doubled in price from its February low. Some think of Russia as the wild, wild west of the investing world, but with the kind of gains that market has seen, a lot of investors may be ready to saddle up. Hold your horses. Scott Licabelli is director of Red Star Asset Management, and he's going to tell us whether or not it's a horse you want to ride. Is this a situation where the gains you're likely to get outweigh the risks?
Well, I think, when you look at Russia, where there are so many corporate governance issues, compared to many other large emerging markets, a lot of investors are quite apprehensive about sort of taking the plunge, so to speak. But I would say that the way we look at Russia, we sort of have a top-down view in terms of how we look at emerging markets. Russia is effectively the provider of the commodities that the other large markets, particularly India and China, are going to need for decades to come in order to fulfill their plans for economic growth. So while it may not be the most efficient market, it may not be the most ideal in terms of demographics, we still see that the tremendous natural resources wealth that the country has bodes very well for the equity markets in Russia. And despite obviously the run that they've had thus far, and also considering that we've almost pretty much reached fair value in most of the first-tier blue-chip names, there still remains quite a bit of value in Russia.
All right, where do you find the value? What would you look at?
Well, I think generally when you're looking at Russia, that you can kind of look at it in terms of there are two aspects or two scenarios that might play out going into 2010. The first one is obviously sustained, or well, not sustained, but economic growth picking up globally, particularly within the emerging market space, or perhaps led by the emerging market space, if you believe in the decoupling argument. Clearly, we're seeing in China and India very robust economic growth. If you believe that, then clearly the Russian equities in the oil and gas sector, Gazprom, Rosneft, Lukoil, Surgutneftegas, all of these names represent substantial opportunities in order to capture the commodity upside associated with the overall growth and demand for natural resources in the other emerging markets. If, however, you believe that the growth that we're seeing picking up in at least so far, picking up in China and India this year, may not continue, may stall, given G3 sort of laggard, economic activity, or assuming things are slowing down or remaining slow in the U.S. and the European Union, then we may if we enter into a stagflation scenario, then Russia also offers a very good hedge against that, because you have a situation where the country is very heavily dependent on movements in oil and metals prices, which are dominated in dollars. So therefore, we see that as a very good inflation hedge, and also so you have sort of both sides of the scenario there. You can do quite well with Russian equities.
All right. Companies that you like over there, are they at this point ones you can trust as well? I mean, you can make a case for investing in some of these companies, but is there any fear that they're going to end up being nationalized, or that you're going to lose your investment?
Well, in the case of Gazprom and Rosneft, they already are state-run companies. Yeah. So I mean, you have very little risk in terms of minority shareholder rights being violated. There are other opportunities, like if you look into the in the metals sector, for example, you can look at Vixa Metallurgical Plant in Russia. They produce large diameter pipe, railway car equipment, agricultural machinery. This is part of the Metallo Invest Group, and this is a perfect example of what you're talking about. On a EV to EBITDA basis, this company is very cheap. It's trading at around, I think, four times, about 9 times PE, 2009. So very cheap company, but it's part of a holding structure, and there is a risk that the very flamboyant gentleman who owns it, Mr. Usmanov, might in some way harm minority shareholder rights. But on the other side of the coin, you could also argue that it's probably in his interest, as he consolidates his assets, and I would assume at one point, when market conditions improve, prepares for an IPO, that it would be likely that there would be substantial upside given the disparity in valuation compared to similar names in other markets. When you go into obviously less liquid markets like, say, Ukraine, you have steel, or you have pipe producers there and steel producers that are trading at much higher valuations valuations, but clearly the risks there are even greater. So I would say in the case of Russia, it requires very, very careful stock picking to be aware of what the potential corporate governance risks are. But I would say that a lot of that has been shaken out over the past 5 to 6 years, and we're kind of left with some very large state players where the valuations are still relatively attractive, or smaller subsidiaries of companies that will be rolled into holdings where the risks may not be as great as some may believe.
I know you also put money into China. A lot of focus on that recently with some reaction around the world to the Chinese markets. It's not a market you directly invest in. What do you look at there?
Well, within just speaking about the A-share market there, basically we think that given the correction that's taken place during the month of August, there are a couple of opportunities. And then again, this is sort of the other side of our investment hypothesis that yes, we're very focused on the commodities associated with these high growth economies such as China and India, but particularly in China, we do like some very compelling stories. If you look at Angang Steel, that's a very interesting story there. Basically, the company is part of a holding structure which they basically are not fully self-sufficient, but make a substantial amount of their own iron ore, have it within the group. So we feel that that's a good story, and there could be very strong earnings growth in 2010. Should we move into mid-cycle in the steel sector, the upstream pressure that you usually get from the iron ore costs rising in step with that will be felt less by this company because they have their own source. Also very similar to a company such as Yevraz in Russia that has a similar situation. So we like that story because we think the demand for steel, the domestic demand and infrastructure story is very strong in China, and given the correction that we've seen.
All right. Well, thank you. Scott Liccamelli, Director from Red Star Asset Management.